Hello, everybody. I'm Jason, the Wizard of Ops. Jay, Dark Matter, had a last second cancellation, so I did not have time to get a new guest on. So you just got me. I'm going to be talking into the camera all alone, talking to myself, right? So let's have at it. All right. First of all, Friday was a big day, right? We got this huge negative print in jobs data and continuation in the Iranian war. And markets tanked 1.3%. I think, in fact, pretty much every day last week, markets dropped at least a little bit, right? So where do we go? Friday also, before I get into Volland too deeply, Friday also ushered in a vol event. So for one of the first times, I guess, since we had that, I guess it's the second time since we had this widget up, we have a vol event right here. Trigger date was on Friday. The target price is 68.22 and the deadline is March 26th. So will we hit it? Let's see. Okay. First, so my plan for this show is going to be, I'm going to walk through how I assess the market, because that's what I do, right? I assess the market. I look at Volland. I see where people are buying puts, selling calls, buying puts, etc. And then I make my determinations. And then after that, I will walk through Dark Matter's plan. All right. But before I actually walk through Dark Matter's plan, I am going to go through catalysts for the week, because he forgot to put catalysts for the week in his plan. So, all right. So let's get to it. All right. As you all know, Vanna is kind of where I like to make my market assessments for direction. Very positive Vanna means typically a bullish kind of lean, and negative Vanna means a bearish kind of lean. The reason why Vanna is so important, as a reminder, is Vanna is the rate at which Vega turns into delta, and dealers hedge their deltas very closely, right? Very religiously. But Vega, not so much, right? They have a little bit of a wider acceptable range in Vega, primarily because they control the pricing of options. So a few things I want to point out. And the first thing I want to point out, I had the 3D vol plane here up before. This is SPX. It's only for like 90 days to expiration, so like 3 months. But the first thing I wanted to point out was the strong backwardation, okay? As a reminder, there are two term structure, I guess, vocabulary words. Today's a vocabulary day: backwardation and contango. Contango, which is normally the case, is when the near-term implied volatility is lower than the distant term volatility, okay? And backwardation is the opposite, when the near-term volatility is higher. In equities, contango is the norm. Like when you're in a normal bullish environment, contango is what you get. That is because in the farther terms, more things can happen. You can get more volatile things, more surprises in that, 90 days from today rather than 5. If you think, what am I going to have for dinner 3 months from now? There's a lot of changes that can happen than what am I going to have for dinner tonight, right? So backwardation is not typical. What this kind of insinuates is the near-term, volatility that we're currently experiencing is not necessarily expected to last very long. And it also kind of tangentially, it implies that there may be some near-term option illiquidity. Okay, that means that dealers probably priced out these near-term options a lot longer ago, before there was an Iran strike, before there were bad jobs data, et cetera, et cetera. So they end up making up for it by overpricing it now. So when I look at the 3D vol plane and I kind of put these days to expiration on the x-axis, 0 being over here. I mean, you could flip it around. You could rotate this thing however you want. But this is kind of how I like to visualize it. you could see that the implied volatility over here has gone up. All right. And we are 11 days away from the March OPEX. And, March OPEX positions were entered in February. There were some long puts back then, and there were a lot of short calls. But there were also a lot of short puts as well. So what we're seeing right now is dealers are now pricing in some backwardation. They're pricing in a lot closer vol, or a lot higher vol closer to expiration than what is 3 months from now. Another thing to note, though, next week is VIX expiration, right? The implied volatility expiration is next Wednesday. So if so these kind of dynamics may be playing out here. We don't, we don't know how long Iran conflict is going to go. Not very likely it's going to end within a week or two. So dealers are pricing that in. If you have a calendar, this kind of stinks for you, right? Like if you had a short March strike and a long, maybe April or end of March strike, this kind of hurts your position. But eventually all implied volatility comes back to zero. So really when I look at the backwardation that I see here, I'm looking right here, are these strikes going to start backwardizing? Like after March expires and people started positioning themselves in April with knowledge of the Iranian war in particular, maybe not the jobs data, we'll have to see later, but with the idea of the Iranian war, did customers position themselves in the expensive time, right, or the cheap time? And we'll take a look at that later on as well. So first thing to note is that we are seeing backwardation in the option term structure. Okay, near term. So that actually sometimes in some ways presents opportunities, right? If you have a calendar now and you sell those front months and buy those back months, you will see a lot of positive swing there, because eventually it'll be IV will return to zero when those options expire. So there is opportunity, but you do also kind of have to know a direction. You cannot go into it just blindly throwing calendars on, right? You have to kind of have an idea of where to put them on and what terms to use. So, all right. The peak here backwardation is 11 days till expiration. That is approximately March OPEX, I believe, right? So that is what we're going to be looking at. Going to try to focus in on March OPEX, since that's one of the bigger strikes. So, all right. Oh, we dropped. It was like 66.80 like 5 seconds ago. All right. So here on the top, on the all expirations, this kind of plays into the backwardation theme because this hasn't changed very much. So there wasn't anybody buying a ton of puts here. Even when I zoom in, like this is not many puts, right? Not many people are buying puts. I don't think people are thinking this will last very long, right? Like it seems like the base case as far as the market's concerned is that the Iranian war will end pretty quickly and, we'll return to normal markets, right? However, there is not really many hedge funds that like to lose money in the beginning, especially, really any time, but there's not really many hedge funds that like to have the view of losing money. So down here on this week, we're noticing a lot of puts getting bought. And this was on Friday, including right here at 6,800. At 6,800, there were a lot of puts bought. This big downswing here in Vanna, these are puts. And in the money puts are an extremely bullish force. Why? Because first of all of the gamma is now negative up into 6,800, right? This should be, or 6,700. Was that 6,700 or was that 6,800? Well, 6,800. But yeah, so all the puts here, right here, we're experiencing negative gamma. This is like that, a lot of you Jexers out there, which not a good Jex is not a very accurate look at the market, but the Jexers kind of have this paradigm in their head. Positive gamma is not very volatile and negative gamma is very volatile. That is true. Positive gamma is not very volatile, and negative gamma is quite volatile. And we're in this negative gamma kind of area. However, on the shorter term, this, and I'll expand here and I'll show you in particular. If I edit and I go just to puts, you can see this 6,800 is right there. And as we get closer, and 1 week gamma is not going to be very much on the all expiration gamma, but you're going to see as we, if we advance, it will speed up, and this will probably fall. Like 6,800 is such a huge strike that even if we drop further, 6,800 will, it will have an impact. It only takes like a couple buyers, right? And then, that negative gamma push. And in addition, the negative Vanna will shrink and then become positive once 6,800 is passed. So all it will take is a little push, just a little bit. Obviously, the Friday jobs data was very scary. It was negative 92,000 jobs, I guess, 92,000 jobs taken away. There were a lot of kind of measurement dynamics there. And honestly, this jobs data survey has had a low response rate for a very, very long time. Low response rates kind of make bad data, okay, when it comes to surveys, especially. And, negative 92, I think, is a bit overstated. There was a Kaiser Permanente strike. There was a lot of weather in February all across the U.S., but in particular, the Midwest, the Northeast, everybody had some snowy weather, sometimes feet of snow. That reduces construction and a bunch of other jobs too. So there's a lot. And there was also a recalibration of the birth-death adjustment, seasonal adjustment. And that alone will remove a lot of jobs. I think it did when they adjusted it for prior months. You saw that there was a huge adjustment in the jobs data because of that, because of the birth death factor adjustment. So it's not as bad as it seems, but it's still not good. I mean, the economy is not healthy. It's just statistically healthy, right? So that's just putting the jobs data in context, and the fact that all these puts being bought, this is supportive. This level right here, which is now 65.80, used to be 6,600, but it looks like some more puts were bought. This is the area I would be looking at if I'm looking at a cascading massive downturn. 65.80 is a great strike to target that, okay? If we hit 65.80, we will see a huge vol IV expansion and probably a fairly strong drop. Right now, for today, we have a 1.5 spot vol beta, again, 2 being the vol event indicator. 1.5, that's actually not that much, right? Like, we've seen worse, right? In the pre-market, especially if we're down, 80 points, 100 points, something like that. If we're down that much, 1.5 actually is kind of saying we're getting closer to a bottom here. I was obviously not expecting a huge jobs miss on Friday. I was expecting, but overall here in Vanna, we're looking at still quite a bit of bullishness, right? We've seen a lot of puts getting bought. This is for April. April puts started getting bought. This is for March and including the end of March, so that quarter end. A lot of puts are bought here as well as a lot of calls getting sold right up here. Again, this area now for end of March, it's like 64.50 when you could start, seeing a huge vol expansion. And even this week, we moved down to 65.80, saw a lot of puts getting bought, particularly at 6,800, which are now in the money puts. I expect a bounce today in pretty much all tenors, especially with sold calls. We are seeing a lot of bullishness. I'm not saying we're all clear for, all-time highs again. I don't think we will get that high, but I do think that between the vol event here at 68.22 and a lot of calls being sold and a lot of put support over the next couple weeks, probably into March OPEX, I expect a pretty decent size bounce. I also expect that backwardation to normalize, that 27 vol in March, March OPEX options. I expect that to crash as well. So I think that over the next couple of weeks, just like 2 weeks, I would expect a nice, a pretty strong rally. That'll probably get a lot of macro people, wartime people, very riled up. War, by a human standpoint, is a terrible thing. But for American markets historically, war overseas, which we haven't had any real wars not overseas, but war overseas has tended long term, like in months time frame, to be a little bit of a bullish catalyst because of higher fiscal spending. We don't actually suffer a lot of casualties ourselves. And also more reliance on American energy. Like now, people in Southeast Asia are not getting their natural gas because the Strait of Hormuz is closed. Where are you going to get it from? I mean, America has plenty, right? So, so that's the kind of stuff to, I hate saying it because war feels awful and I hate that we are at war, but historically for markets, it's been a little bit of a bullish force long-term. So, all right. So that is my view of the markets right now. Again, I see a bounce this week and next week. It doesn't mean we're all clear. And, the other thing to account for is our debt obligations are very, very high right now. If treasuries can rally, which they are today, then that kind of sounds a little bit of, all right, that's not a concern yet. I've been waiting for a long time, honestly, to see treasuries start to disconnect from the Fed's rate. That's like a big liquidity alert for me, right? That's when everything, options, bonds, everything will have a massive liquidity crunch, but we're not there yet. And if you're trusting other sovereign debt situations, America has a little bit of ways to go before we get there yet. So maybe like a couple of years. So, all right. That's what I have so far for Vanna. And I will kind of touch a little bit on zero DTE. We are seeing quite a few, this is positive, like negative is positive here in zero DTE delta decay. These are positive forces. I would expect if we do drop, we will probably not drop past 6650. 6690 would be the first thing to climb over. And if we can get over 6700, this could be that we can rally pretty hard back up to even 6750. So if we do close the gap today, I do think it will take off pretty hard. And 6750 would be the highest, like that would be my zero DTE target. 6690 has to be broken first though. So that's what I got. All right. So now in Dark Matter's trade plan, he has not yet put on, he has a nice thorough trade plan, which I will go through in a little bit because, but first I wanted to go through the news. He doesn't have any news on his trade plan. So I have to, I'm going to go and I'm going to share a different screen because our new partners at Financial Juice, I've actually been a Financial Juice sub. I mean, this is like the greatest news aggregator. And when, I joined their Discord group, and it's really, it's really engaged and collaborative environment. And I even did like a couple of sessions over there, just kind of teaching people about market makers. So I mean, I'm going to use Financial Juice to kind of look at the catalyst for the week. Nothing really much today, but I think on Wednesday, we have existing home sales. That's been kind of dropping quite a bit, at least in my area. There's a widening gap between job sales, or between seller demands and buyer willingness to buy. So I don't know how that's going, but we're going to see Oracle earnings. These earnings are Oracle has canceled one of their data center contracts, I think, with OpenAI. Oracle seems to be the only company that has a realistic view on the AI debt situation. I think that that the AI debt situation is going to be something that will come into more of a focus later on. I think, eventually, and again, like months down the road, these, Meta and, all these large players that are in the AI space, that debt's going to catch up to them because they're not going to make enough money to pay for all that. They will have some assets, though. I mean, all those data centers are not worth nothing. So anyway, okay. So Wednesday, this is inflation week, right? We have the Japanese inflation for PPI. CPI, I don't think we will see a lot of difference. You see right here, we have the 2.4 and month over month, maybe 0.1, core kind of staying stable. This is because the CPI was collected before the Iranian war. We'll probably see a spike in headline CPI next month, but this month we probably won't see anything. EIA crude oil inventories, this is something to watch for crude pricing, right? I don't think we are going to have a large inventory increase. I think that probably eventually we'll hear Trump say that he's going to release some emergency reserves. This is the time to do it. When oil is high, you release the reserves. When oil is low, you build them up, right? But anyway, that's, probably a next step in the whole war. March 12th, trade balance, jobless claims. The jobless claims will either justify the NFP move or it will put it into perspective. So we'll see. It looks like we're trying to put it into perspective when we look at 215K jobless claims, only up 2K from the previous month. Ah. Oh, I hit the wrong button. Sorry. All right. So that's another thing, by the way, that I really like about Financial Juice is that if you want to see these numbers, you can just click on here and it'll take you directly to the source of the data. So I love that. That's very valuable for me because when I look at things, I don't like to look at necessarily the news. I like to look at the source data. So that's definitely a plus for me for Financial Juice. And then here, March 13th, I guess it's Friday or Thursday or Friday. We're going to get the PCE data, right? And GDP quarter estimate. Okay. The PCE price index is a bigger deal to me than CPI because that includes a lot of producer data. And it also includes a lot of entry data, right? Construction data, it gives you exactly how much construction was done in a dollars standpoint. So, I mean, stuff like that. And it looks like we're not expecting very much inflation. It looks like coming down. But again, oil is a big deal. That will happen. Oil will be a big catalyst. This durable goods number is something that I'm looking at. We're expecting positive 1.2, recovering from negative 1.4. I'm not as in tune with that number as I am, as I would be with like inflation. But that is interesting to me when I saw this before. So that's what I got for news. And now I will, I'll stop sharing that, and I will now go into Dark Matters. I'll now go into Dark Matters trade plan. So trading guy, I'll talk about your comment in a minute. Let me just go through Dark Matters trade plan and we will. All right, here we are. So, all right. So Dark Matter, when he wrote this, apparently it was yesterday at 9:31. We had a major gap down on ES. ES gaps, I am told, don't last very long. I mean, from a technical standpoint, like when you look at what ES is, they technically shouldn't really happen. So it's kind of interesting to me when I see those kind of gaps because you know, when you look at the mechanics of what futures are, they shouldn't really happen, but lo and behold, it happened. So, and he's selling isn't going to need to hold 6,600 ES. Important level. Yeah. So that 65, we were talking before about 65.80 being a very important level. It appears that he agrees with me right here, 65.80. He has S&P futures are trading 6601 SPX. That has since bounced about 60 points. I think we actually hit like 65.80 in the overnight action, right? I was looking, it looked like we bounced off of something that would be close to SPX 65.80. And now we're up in like the 66.60 area. Remember, we are in a vol event projecting to 68.22. So yeah, overnight broke through several intermediate balance shelves. Yeah, so those balance shelves kind of thing, that's a dark matter thing. He's much better at volume analysis than I am. I'm very data analysis driven. And I just haven't looked at volume that closely yet. This dealer stuff that you hear me talk about all the time, that's been giving me quite a bit of edge in itself. So, yeah, but it is something that I think has edge and I'd like to learn more about. But all right, the most important structural change overnight was the loss of the 67.10, 67.20 SPX region. Okay. So again, this is more like volume. When that support market transition from balanced auction behavior to liquidation mode. I mean, the liquidation mode, usually when I hear liquidation, that means that market makers are stepping out. People are not as many people are providing liquidity as they were before. On Friday, we saw a lot of that, but we also saw a lot of puts getting bought. So they were starting to kind of come back a little bit. I think a lot of those puts were bought that last minute like drop that we saw. That's when a lot of puts were bought. So I do think that liquidity kind of came back a little bit. The spot vol betas being only 1.5, I do not see a liquidity event right now. But I don't know if that's like liquidation mode may mean something different in the volume world than it does to me as a options, I guess, viewer, looker, or whatever I am. Whatever I am, liquidation might mean something different. So yeah, so it created a launch. All right, so his big level is 6600 SPX, and that is on the volume standpoint. So I guess that area of 6580 to 6600, that's a key area right there. I can look real quick at his view here. He's looking here, weekly bounce. I guess he did this yesterday, so he doesn't see the wick going down to the 65.80 something. So maybe this purple line would be a little bit farther down. But it looks like, yeah, this looks like a lot of these dashy lines. I mean, it looks like he might be targeting this. I don't know, the 65.29 area. I don't know. Let's read. Oh yeah, so 65.29 major downside support. So he thinks that is a really large breaking point. I would add in here that 65.80 like put spot. That's my big downside here, and he has 66.01 here as control support. So I don't know what control support means, but what I do know from my standpoint as a Vanna guy, or as the guy looking at the dealer position, is 65.80 is the big strike on the near term. 64.50 for me is a big strike. I guess this would be his structural support down here. That is the end of puts for April. But yeah, so for March though, it's 65.80, and I think 65.80 will be very tough to pass, extremely tough. So because also of the inflated near-term implied volatility, I also expect a little bit of a bounce. It looks like from what Dark Matter is saying here, he's looking at VIX over here. From what Dark Matter is saying here, I don't know if he's looking for a bounce or if he's looking for breakdown. I think he's staying a lot more nimble. I I mean, I've sized down quite a bit since the beginning of the month, but yeah, him staying nimble here is probably a good call, right? He likes this cluster right here, this 50, 65, 95, 65, 90, this area. Positive gamma, positive Vanna exposures overlap. Okay, so yeah, so he's looking kind of in the same area that I am. That if that breaks, then I would expect a major vol event. There's a lot of customer sold puts there they would want to get out of and or hedge. And if they're going to hedge, they're going to sell, right? So it can cascade pretty quickly. I don't think that will happen necessarily. I mean, that's not my base case. My base case is over the next couple of weeks, we will bounce. We will satisfy that vol event, and we'll bounce, back into the 6,800s. Maybe as high as 6,900. I don't think 7,000 is in the cards, but I've been surprised before. So yeah, I mean, that's kind of my swing term bias. Relative to the prior structural state where the market traded above mid 6,700s, the overnight gap lower. So he's looking at this as well, 6,600. I think 6,800 will probably that will be, I think, passed by the end of the week probably. I think we'll bounce up to there, and all it takes too is one. I said 7,000. I don't think it will. If the Iranian war ends, I mean, and we have like all of this juice to go up. I mean, we've been shocked before by, by transitioning catalysts like, negative, war, and then war ends. We had that earlier last year, around April, around this time last year, tariff, taco, we went up like 10% or something like that. So yeah, so it looks like dark matter here is going to be a lot more, he's a lot more, I mean, I'm being nimble too, but he's being very nimble. He's protecting himself, and that's great. That is a sign of a good trader, is if you're managing your risk. So continuation scenario of price loses stability. Okay, around 6,600, 65.70. Yeah. So we're looking in the same spot. All right. It is 9:17. I have a little bit of time for some questions. So I will now stop sharing, and let's read what you have to say. All right, the trading guy. How to use Volland for shorting VIX. Put spreads March 26 based on overfix single. Okay. So shorting VIX, that is the VIX pricing structure assumes quite a strong level of mean reversion. So usually when you get into these over VIX kind of scenarios, I would look more toward look at what you think implied volatility will do and trade short VIX, that is short gamma trades in SPX. Don't trade it in the VIX complex. I stay away from the VIX complex until I get a better handle on the pricing structure. Right now, my edge is in SPX. That is what I will, be trading in. On Friday, I did put a very wide butterfly, expecting, a large drop in near-term implied volatility. So that's kind of what you could do, like do a butterfly in SPX, maybe a little bit higher, figure out your direction a little bit. You could delta hedge, like if you're a little bit sophisticated, you can buy and sell ES futures or MES futures, delta hedge. That's, dealers do it. You can too. So that's what I would do. And that's how I'm trading this. I have a large, wide butterfly for late March. Good day, Johannes. Julian, good day. Any ideas how I can share how to trade the vol event? A bull call spread comes to mind. Thoughts? So the problem with the bull call spread, and that will help. That will make some money. But a bull call spread is going to be a little bit weird with your skew. The longer term short call is going to be lower implied volatility than your short term. And that is a very positive Vega trade. It's a bull call spread. And part of the vol event thing is that VIX will drop, right? So if you're doing a bull call spread, you're going to have skew working against you and implied volatility working against you. Your bull call spread is probably going to be pretty expensive. That is why I chose a butterfly, because, but you have to place it right. Butterflies are also skew trades. Okay. So, when you put that short strike, you don't want to put that short strike in your butterfly where you think the market's going to go, because of the skew dynamics of SPX, that being put implied volatility is a lot higher than call implied volatility at the same deltas. So because of that, you want to do something that would be a little cheaper. You're kind of selling vol with that sold call spread side of the butterfly. So you put that short strike well above your target. And then once you reach your target, it should be around delta neutral. That's when you sell. Okay. That's when you sell. That's when you take off the position, put the money in your pocket. Thank you very much. Have a nice day. Right. That is how I particularly like to trade these vol events. You have to make it wide though, because if you want to, if you don't make it wide, you can blow by, your butterfly, and you end up losing money, even though you had the right thesis. So you have to make it very wide in order to neutralize that possible effect. Okay. It will reduce your gains a little bit, but that's always worth it. Like I said, the risk management mindset is the one that makes a successful trader. So Ramirez, a put calendar makes sense if you are bulls, selling a short dated put, buying the same strike week ahead from profit. Oh, okay. So I see what you're saying. A calendar will be actually not too bad. Especially if you're putting the short strike in the March OPEX, and maybe like the long strike in April or even May. They get expensive though, especially in this high vol time. It's going to be expensive. So you might, if you have a lot of capital, it is a good trade to have. You could also try to do a little bit of a call spread or call calendar if you want to make it shorter term. But I'm just saying, if you have a calendar, it would help you. I'm not necessarily recommending a calendar because that will have a lot of capital. It'll be capital intensive. Okay. All right. That's what I got for questions. It is 9:22. I've been on bantering all by myself here for 35 minutes. So, thank you everybody, and may Volland help you in your future trading ventures.